Good afternoon, everybody. This is Samantha from the law offices of Samantha Wolfe, and I'm here for this month's virtual seminar. And I'm excited because it's Christmas. We're getting ready for the holiday season, and so I always think of gifts and gift giving this time of year. So today we're going to focus on gifting and what that means. And so let's go ahead and pull up our PowerPoint and share, and we're going to go through our session today. We always try to do monthly virtual seminars. You can check us out on YouTube. We always record our seminars and post them after. And we do this as part of our mission statement because I just think it's important to be able to provide educational resources for our clients and referral sources. And anybody who has any suggestions about upcoming seminars, you're always welcome to reach out to us. We're always looking for new and exciting topics to discuss. So today we're talking about Don't Be a Scrooge, the ins and outs of gifting. So let's talk a little bit about what is a gift. Like I said, I always think this is a good seminar to give around the holidays because we're all thinking of gifts to give our family members or our friends. In the context of legal things, though, I want to talk about what is a gift. A lot of times clients will come in and they'll talk about transfers that they've made to children or family members. And as we're talking, we'll realize that it was in fact a gift that they made, not just a transfer. So let's talk about in what context are we talking about there being gift. So one area where there would be a gift is where there's a transfer and there's not adequate consideration. So this could be a transfer where maybe you transfer for $1, or you might transfer for a certain amount where a child is paying you, but it might not be the fair market value. And the fair market value in Pennsylvania can either be an appraised value, meaning you go out and get it appraised by a certified appraiser, or in Pennsylvania you can also use, if it's real estate, the tax assessed value multiplied by the common level ratio factor for the county, which they update every July 1st. So right now in Franklin County, it is 12.2. And so you would take the tax assessed value and you multiply the tax assessed value by that 12.2, and that would give you a fair market value. So if you're transferring real estate to anyone and you are not actually charging them the full fair market value, that is going to be considered a gift for federal gift tax purposes and for Medicaid purposes. It could be that you do a loan to an individual and there's no interest that you're charging, and so the IRS is going to look at that as a gift, because if they went through a bank or financial institution, that institution would charge them interest. So because you're not, it's considered a gift of the interest. So that would be another example of a gift. Adding children's names to the deed would be also considered a gift that you're making. It would be a gift of that percentage that you're transferring or adding their name to the title. And then if you transfer your home and continue to live there, so if you would, for example, retitle it in your kids' names, and there are a couple of reasons you might want to do that, one of which is nursing home protection. But if you would do that and you're not paying rent to continue to reside there, then that's going to be considered a gift as well. It's a gift that your children or whoever now owns the property is making to you because they're not charging interest. So a gift can go both ways. It can go to you as a client if you're the parent, or it can also be a child can make you a gift if they aren't charging you rent and the property's been transferred to them. Next thing I wanted to go over is the two types of gifting, because we think of usually federal gift tax and the gifting related to that. So clients will come in. I had one this week that says, well, what's the limit of the gifts that I can make per year to my kids? And what they're talking about there is the federal gift tax. And that is an amount that you can transfer. There's an amount you can transfer and not have to pay any tax or file a gift tax return. That's what we call the annual exclusion amount. And then there's a federal gifting exemption, which means as long as you don't gift over that amount during your lifetime, there's no tax on it. And when we're talking about a federal gift, two questions we have to ask is, was there consideration and was it adequate in the amount based on the fair market value? And did you lose dominion and control over the asset? And if so, then that would be considered a gift for federal gift tax purposes. On the other hand, there's Medicaid gifting. And Medicaid gifting is the one that seems to trip everybody up. And that's because you can be in compliance with the federal gift tax exemptions and the amounts, but it still can be considered a gift for Medicaid purposes or for nursing home purposes. purposes. So this would be transfers that would even fall under a federal gift and not be subject to tax. You could still have made a gift for Medicaid purposes. So for Medicaid purposes, it would be anytime you're transferring more than $500 in any one month. And that's not $500 per the recipient, that's $500 per donor, meaning that if you're giving money away and you have 4 kids, you would have to divide that 500 among all 4 kids in order for it to be under the threshold for nursing home and Medicaid gifting rules. The next thing I wanted to talk about is that when we're talking about gifting, I always like to mention that you want to make sure that you have a financial power of attorney in place that does allow for unlimited gifts. The reason why is in Pennsylvania, as it deals with gifting, if your financial power of attorney just allows your agent to make a gift and it doesn't say unlimited in nature, then they're capped at whatever the federal annual exclusion amount is. So in 2025, we know that's going to be $19,000. So if your financial power of attorney doesn't say unlimited gifts, then your agent acting on your behalf would only be allowed to transfer $19,000 or less in any one year. And this is important because when we're talking about especially Medicaid gifts or gifts for nursing home purposes, you may want your agent to be able to make transfers that are larger than the $19,000. Great example would be a husband and wife where maybe one spouse is going into a nursing home, and we might want to take that institutionalized spouse's name off the deed. And if we did that, the house is worth more than $19,000. And so if the well spouse is the one who signed the deed acting as agent for the institutionalized spouse, that's going to be considered a gift. And unless your power of attorney allows for unlimited gifting, your agent, even as a spouse, would not be able to sign that deed. So I always like to make sure to tell clients that you want to look at your power of attorney and make sure that you can do unlimited gifts, or that your agent can do unlimited gifts, so that if we would need to do Medicaid planning or nursing home planning, we have that capability. Here's a fun chart. This is for federal gift tax purposes. So every year they adjust this threshold. So in 2025, every individual has $13.9 million that they're allowed to gift, and you can gift that during life, you can gift that at death. As long as it doesn't exceed that coupon amount, then there's no federal estate or gift tax. And that's important because the rate of tax is 40%. So as long as you don't go over that amount, then you don't have to worry about the 40%. Now, that being said, if you go over the $19,000 annual exclusion amount, you have to file a gift tax return. The IRS says you are required to file a return. It's just there's no tax due on that gift that you made because you're under the 13.9 million. So again, clients come in and they're always worried about, what am I allowed to gift every year for federal income tax purposes or federal gift tax purposes? And the answer to that is, well, you're allowed to do $19,000 in 2025, and you don't even have to file a gift tax return. But you can gift over that and there's still no tax. You just have to file the return. So the annual exclusion amount in 2025 jumps up to $19,000. So in the last couple of years, we've been in an unusual situation where the annual exclusion amount has jumped $1,000 every year. That's unusual because normally the annual exclusion amount lasted for a couple of years. Like, for example, if it was $19,000 in 2025, we may not see it jump to $20,000 until 2030. Sometimes it was a 5-year period, a 7-year period before we saw the up to the next 1,000. But obviously we've seen inflation, all of that happening. So the last, I think, 3 years, it's jumped by $1,000 every year. So we're now up to $19,000. 2025, you're allowed to gift $19,000 to as many people as you want to, and it doesn't count towards your gift tax exemption. In 2024, it's $18,000. So until December 31, you can give $18,000. January 1st, it then does increase to $19,000. Federal gift and federal estate tax exemption, like we talked about, is $13.9 million. So what can be excluded from gifts for federal gift tax purposes? This is important because I know we have a lot of generous clients that might gift to grandchildren or children or other individuals. And so what's important to know is that you can make certain transfers and it doesn't count as a gift at all. So they're excluded. So that would be gifts that are not more than the annual exclusion, so that 19,000, tuition or medical expenses that you pay directly to the educational and medical institution. So for example, when I was in college, one of the things that they always told us in the financial aid office is if we had somebody that was generous and was going to be contributing towards tuition, it might be better, instead of the person writing me a check in school, it might be better for the donor or the person who's giving the gift to write the check directly to the university for tuition. Because what that does is it doesn't even count towards a gift. Don't have to worry about the 19,000 or the 13.9 million. You can just make that transfer. Then in addition, if I have a very generous benefactor, that individual could then pay $19,000 towards my books or my room board, those type of expenses. So again, if it's a educational or medical institution and the check is made or the funds are transferred directly to that institution, it's considered an excluded gift, meaning it doesn't even count. You don't have to worry about the 19,000 and the 13.9 million. The next category of excluded gifts is gifts to a spouse. So if you want to make transfers between each other, if you have an individual account and you want to make it joint or you want to transfer funds between it, no problem transferring between spouses. It's not considered a gift when we're talking about federal gift tax purposes. And then lastly, this would be any qualifying charity. We wouldn't have to worry about that being considered a gift as well. So this would be the classification of transfers that you can make that don't use up any of your federal exemption. How many annual exclusions are available? So the exciting part about this is that for 2025, the annual exclusion amount is 19,000 for individuals. If you're a married couple, it can be 38,000. So if my parents wanted to gift me 38,000, they and we don't have to worry about any gift tax return filings or anything like that. Now, that being said, what I would tell my parents is if they were going to do that, each of them should write me a check. So even though it's a joint account, my dad should write me a check for 19,000 and my mom should write me a check for 19,000 and sign it that way. And the reason why is because if my parents just write me one check for 38,000, then a gift tax return does need to be filed. No taxes due, but because it's a gift over 19,000, they just have to disclose that they're splitting the gift as a married couple. Each one is gifting 19. So it's better if you're going to do that to each spouse sign a check to the intended recipient. So that way we don't have to worry about filing a gift tax return. In the situation where we have a couple with 2 children and 3 grandchildren, they would be able to make a transfer of 190,000 because mom and dad would make a gift to each of those 5 beneficiaries, the 2 children and the 3 grandchildren. So it would be 19,000. That would mean that if you looked at the savings of tax with a 40% tax, you could be saving up to $76,000 of taxes each year just by doing the annual exclusion gifts. Now, ways in which you can gift is you can do medical gifts, educational gifts, like we talked about. If you make them directly to the institution and it's for tuition or medical expenses, then it still means you also have the annual exclusion amount on top of that. It doesn't eat into your federal exemption. You can also make gifts into trust, and we're going to talk about the benefits of that. You can make transfers into 529 savings plans. You can make transfers into a uniform transfers to minor account or an UTMA account. You can also gift it by selling property for $1 or making a transfer, adding someone to your account would be another way too. So medical and educational gifts, like we talked about, if it's made directly to a doctor, a hospital, or to the educational institution, then we don't have to worry about filing a gift tax return at all. It doesn't use up any of your exemption. The way that we see this used most often with families is they're looking to make a transfer to the kids and they don't necessarily want the kids to receive the cash or the money. Maybe the child is in college and they do want it to go towards those expenses, and they're worried if they made the check directly out to the individual that they wouldn't use the funds for that, or maybe they didn't want it to be considered a gift. So that would be one way, and that you can be to anybody you would want: children, grandchildren, in-laws, parents, friends, other family members. That would be a way in which you could make a gift. Transfers to trust can be a little bit more technical. It still works and it works beautifully, but we just have to make sure that we're following all the requirements. And that falls under Internal Revenue Code Section 2503. And that's the code section that says annual exclusions are permitted, that 19,000, and there's no gift tax. However, you need to make sure that there's a present interest in the trust. So what that means is if my mom and dad set up a trust for my benefit and they wanted to use that $19,000 per year to transfer funds into the trust for my benefit, because like we talked about, if it's $19,000 or less, it doesn't use up any of their $13.9 million exemption. So if they want to gift me money, but they want it to be in trust, they can do that. It just means that I have to have a present interest in the trust. All that means is that I have to have a 30-day window in which I can withdraw the funds. And if I don't withdraw the funds, then it stays in the trust and it qualifies as the annual exclusion. So it doesn't use up any of the exemption. So that's a way that you can do that. It's called a crummy power. And the reason why it's called a crummy power is because the taxpayer that brought the case that said the IRS should allow transfers into trust for the beneficiaries of the trust if the beneficiaries had a 30-day window in which they could withdraw the funds. And the court agreed and said, yes, that does count as a present interest. So you can make transfers to a trust and it not count as a gift at all, as long as you provide a beneficiary a 30-day window. Now, most clients that I have don't have any concern with that, but I have had a couple of clients that are worried that their children would withdraw the funds in the 30-day window. And what you have to make sure to express to your kids is you don't have to transfer the funds into trust for them. So the options are either you're going to transfer the funds into the trust and they're going to sign the notice saying they received it but not withdraw, or you're not going to make the transfer to them. That would be one way to ensure that the kids are not withdrawing the funds from the trust. Once the 30-day window passes, then we're good. The funds can be used in the trust and invest how you want it. So this is a picture of a trust or a plan that we use a lot of times for clients that are worried about nursing home protection. And so they want to protect assets, make sure that the assets in the trust are not available for their long-term care or their nursing home costs. The reason that they do this is that there's a 5-year look-back period in Pennsylvania for transfers for nursing home purposes. So meaning that if my parents wanted to transfer money to me and then they needed care within 5 years, that money that they transferred to me is going to be available to pay for their care. So we use trust sometimes to go ahead and trigger the transfer, start the 5-year look back period. Now, what's important to know is when we use these type of trusts, it is considered a transfer or a gift for Medicaid purposes. That's why the 5-year look back period applies, but it's not considered a gift for federal gift tax purposes. So we don't have to worry about filing a gift tax return. We don't have to worry about any federal, estate, or gift tax implications to that, because in these type of trusts, the client retains the ability to add and remove the beneficiaries. And because they retain that, then it's not considered a gift for federal gift tax purposes. It's still in their estate, they're still in control of it, still uses their social security number as the taxpayer ID number. So again, the reason people use these type of trusts is because they want it to be considered a gift for Medicaid purposes. They want to start that look back period, but they don't want to have to worry about gifting for federal gift tax purposes. Now, you can make gifts to spouses. So what's important to know is that your spouse can still be a recipient of that $19,000 every year. So when we have clients that have individually owned accounts, sometimes we'll still recommend that they transfer $19,000 to their spouse because they're allowed to do that without having to worry about that. You can do a trust that the grantor creates for the benefit of the spouse and descendants. We usually call that a spousal access trust. That is just a way to do federal estate tax planning. And Again, we're not seeing as much of that now because we have 13.9 million, but just know that is available if you need to do that type of planning. Now, when you're doing gifts to the spouse, it must be separate property of each other, meaning that if it's a joint account, obviously you aren't gifting anything to your spouse because they're a joint owner. This would have to be an individually owned account in husband's name, and he wants to transfer it to wife, so he can do that. You can do that in trust, and you can still use those withdrawal powers, so it counts for the annual exclusion. Now, you can't split the gifts between spouses if the spouse is a beneficiary of the trust. And if you would do a $19,000 gift to your spouse for 15 years, you would remove $285,000 from your estate. Now, again, we're not as worried about that now with the 13.9 million, but it's something that we should still know is out there just in case we would need it. Now, there are discounted gifts that you can make, and you can do that using entities. So if you use a family limited partnership, that's what FLP stands for, or an LLC, which is a limited liability company, you can make gifts and you're allowed to discount the assets that are owned in the FLP or the LLC. And the reason why is because you include transfer restrictions in those business entity governing documents. So for example, an LLC has an operating agreement that says what are the rules on how to operate the entity. And because there are certain rules, then the IRS will say, well, we'll discount the value of any asset owned by that business. So you can usually take a discount of about 40%. So if you have, for example, an LLC that you think is worth $5 million, but you have family members as other owners and there are those transfer restrictions in the operating agreement, you could discount that $5 million by 40% when you're making the gift. So here's an example. So a family LLC owns real estate and certain farming property. There are transfer restrictions that you can't transfer ownership to anyone other than immediate family, that would be sibling, children, parents, without the written consent of all of the members of the LLC. So what that means is that the LLC is valued at 4.2 million, you could give a 30% discount, which means that it would only be worth 1.2 million, and that would allow you to transfer a larger ownership percentage to children and not have to use as much of your federal exemption. So that's why LLCs and FLPs are so important when we're talking about planning. All right, let's pivot and let's go to 529 plans. So 529 plans are college savings plans. It's almost like a retirement plan, but for education. And the main advantage of this type of plan is that when you make contributions to it, then the account can grow tax-free. So that's a wonderful thing. If you put $10,000 in there and then it continues to appreciate, all of that is tax-free. Now, that does have some limitations, meaning that a 529 plan we typically think of has to be used for educational expenses such as tuition, books, room, and board. Now, in addition, you are allowed to transfer $10,000 a year can be used for tuition related to a kindergarten through 12th grade education. Otherwise, it's typically used for higher education. And if that money is used for other purposes, then the withdrawals are subject to income tax, and there is a 10% penalty on the earnings. So you only get that tax-free growth if it's used for qualified educational expenses. With the 529 plan, it is possible to front load that plan with 5 years of the annual exclusion. So the annual exclusion is $19,000 a year. For 5 years, you could contribute $95,000 in that 1 year or $190,000. So you could do that right when you open the account rather than spreading it out over 5 years. The IRS allows you to what we call front load, which means go ahead and put all 5 years in that first year in the plan, and they will allow you to do that. Typically when you do that, you'll file a gift tax return and just explain that yes, it is over the 19,000, because obviously they're going to see either 95,000 or 190,000 going into the account, but you just explain that you're using the front loading mechanism that allows you to do that, no tax. And then, like I said, that continues to grow tax-free. Now, for 529 plans, like we talked about, withdrawals for anything other than qualified education expenses are subject to income tax and a 10% penalty. That was prior to the Secure Act. Secure Act was something that Trump passed in 2019, I believe, right before Biden came in, and this is saying that starting in January 1st of 2024, so this past year, Secure allows a 529 plan that's been opened at least 15 years to be rolled over to a Roth IRA without penalty by the account owner. So prior to this, any withdrawals for anything other than educational expenses, you were looking at income tax and a penalty. But Trump passed a law that said that you could roll it over to a Roth IRA. Now, up to an aggregate lifetime limit of $35,000, and it is subject to the annual IRA contribution limit, which is $7,000 a year in 2024, and the amount is reduced by any contributions made to the traditional Roth IRA for that year. 529 contributions made within the last 5 years are ineligible. So technically, it would take 5 years to roll over the lifetime limit of $35,000. The beneficiary of the 529 plan must be the owner of the Roth IRA and have earned income equal to or greater than the amount they plan on rolling over. So this isn't a fix for all 529 plans because, again, you can only do this up to $35,000. But at least it does give us a way if we have a beneficiary that has excess funds in the 529 plan and you don't have another beneficiary that you can assign that 529 plan to. It gives us a way to get the funds out without having a penalty or income tax. Now, Secure 2.0 does allow emergency withdrawals up to $1,000 a year from workplace plans without a 10% penalty. Our next category of gifting that we can use, or the vehicle in which we can gift, are UTMA accounts. So that's uniform transfers to minor accounts. So how these work is that the uniform transfers to minor account allows a minor to receive gifts without the aid of a guardian or a trustee. The minor can avoid tax consequences until they attain a legal age for the state. So, for example, might be 21. And then at 21, that beneficiary is going to be able to have access to that uniform transfers to minor account. The donor can name a custodian who does have the fiduciary duty to manage and invest the property on behalf of the minor until the minor becomes of legal age. And most of the UTMA accounts I see, the age is 21, but it is specific to the account and what the state law is. But once that beneficiary reaches age 21, then legally those funds are the beneficiaries. And the difference between a 529 and an UTMA account is a 529 plan does not have to be used for just educational expenses. So the main advantage of using an UTMA account is that the money that you contribute into the account is exempt from paying gift tax up to the maximum of that $19,000 per year. And any income earned on the funds that you contributed is taxed at the tax rate of the minor who's being gifted the funds. So in theory, it would be a lesser tax rate. Since the minor's income is significantly lower, then that can be a tax savings. One of the drawbacks of an UTMA account, though, is it can make the recipient less eligible for needs-based college scholarship programs or other financial aid that they may qualify for. So remember, 529 plan is just allocated just for educational expenses. An UTMA account can be used for other expenses, but it would factor in as far as financial aid and scholarship eligibility. So how does an UTMA account work? So an UTMA account is when an adult opens the account and contributes funds on behalf of that minor beneficiary. The custodian manages the account until the minor comes of age, which is usually between 18 and 21. And that's similar. They can invest and make distributions similar to how a trustee manages a trust. So if you think about it, a trust can usually be more expensive because you have to have the attorney draft it. You need to make sure that you have all the legal documents in place. An UTMA account, most financial institutions have the ability to create an UTMA account, and you're just signing the paperwork with that bank or financial institution. And all UTMA account assets transfer to the beneficiary based on the age of the account. So again, if it's 21, at 21, it becomes the beneficiary's account. So an UTMA account versus a 529 versus a trust. So an UTMA account and a 529 plan, if you think of it, they're more cost efficient than a trust because typically an attorney doesn't have to draft anything with an UTMA account or a 529 plan. However, a trust typically protects assets more. So a 529 plan and a UTMA account can be available for long-term care costs. So for example, if you create a 529 529 plan for a grandchild and you need nursing home care, that 529 plan is actually still considered your account. So as a result of that, it's available for your long-term care. Additionally, it does have that penalty if it's not used for educational expenses. An UTMA account for tax purposes is considered the beneficiary, so it looks a little bit different than a 529 plan. However, you still have to worry about long-term care costs, whether that account is available for that. And then the other thing with a 529 plan is, what if the child doesn't go to college? You can change it to another beneficiary, and it does have to be of the change it to a beneficiary of another member of the original beneficiary's family. You can do that without tax or penalty, but otherwise you're going to have to look at that Roth option, and that can be problematic. So if you would use a trust, the benefit there is you get the nursing home protection. You don't have to worry about that. You can structure it however you want for tax purposes, and you can guide the beneficiary to receive funds through the trustee distribution under whatever rules you want that to be. So it can be for education, but it can be for buying a house, starting a family, creating a business, any of those, or just certain ages the beneficiary can receive funds. So a trust gives you a little bit more flexibility. Let's talk about the tax implications of selling your home to your children for $1. And I use this example because I'm often surprised how often I still get this question when clients come in, and they'll come in and they'll say, well, I didn't gift it to my kids. I sold it to them for $1. And that is considered a gift because it wasn't adequate consideration. Your house is worth more than $1. So if you transferred it to your kids and you did it where the deed says only for $1, you have in fact made a gift. So let's say you sell your $200,000 home to your child for $1 and you no longer use or occupy the property. The remaining $199,999 doesn't escape federal taxation because the IRS does treat that as a gift. So the tax code provides that you can gift up to $19,000 a year to any one person, and that's an increase from $18,000 in 2024. So technically there was a gift of $199,999. Now that can be reduced by the $19,000, so total it's $180,999 because you can use the annual exclusion for the first $19,000. Now it doesn't mean you owe tax on this because remember you can gift up to $13.9 million, but it does mean that you have in fact made a gift to your child or to your children when you do that. Now let's talk about what that means from a basis perspective. So basis is really important because a lot of times clients will say, well, I went ahead and transferred it to my child for $1. So, okay, it's a gift. And they do that because I want to try to avoid Pennsylvania inheritance tax if they live in Pennsylvania. So if you reside in Pennsylvania when you die, there is a tax and it's based on the decedent's beneficiary. So if it goes to a spouse, it's 0%. If it goes to direct lineal descendants, children or grandchildren, it's 4.5%. Siblings, it's 12%. And anyone else, it's 15%. And that would include nieces and nephews. So a lot of times clients will transfer their house to their children for $1, which means it's a gift, and they do that to try to avoid the 4.5% Pennsylvania inheritance tax. The problem with that is that if you avoid one tax, sometimes it may mean that you get hit with a different tax. And inheritance tax and income tax kind of go together. So the way it works is that if I have a house and it's worth $100,000 and I bought it for $10,000 and I choose to gift it to my children for $1 and I add them onto the deed or go ahead and put it all in their name. What I've done there is I've made a gift and they get my basis in the real estate. So their basis becomes $10,000 in the house. If when I die, they sell it and my house is now worth $200,000, then what they're going to do is they're going to take the $200,000 sale price, subtract the $10,000 basis, and they're going to pay capital gain on the difference. So that would mean they'd pay 15% tax on $190,000. If instead they wait and they receive my house when I die and they pay 4.5% on $100,000, and then they hold on to it and then they sell it for 200,000. The difference is that because they paid inheritance tax, instead of having a $10,000 basis in the property, they have a $100,000 basis in the property. So instead of paying 15% on 190,000, they're only paying 15% on the difference between the 200,000 and the basis that they received when I died of 100,000. So 15% on the difference. So $100,000, 15% of that. Now, in most cases, we have families that when mom or dad pass away, the kids are selling it right away. So if that were the case, they would pay, in this example I gave you, they'd pay 4.5% on 200,000, but their basis in the property is 200,000. So if they turn around and sell it, 200,000 minus 200,000 is zero. They have zero capital gains. So they paid 4.5%, but they did not have to pay the 15%. So the reason I'm bringing this up is sometimes when I talk to families, they'll say, well, I want to gift it to my son or daughter for $1 to avoid the inheritance tax. And when we talk about it, the kids would sell the property anyway when mom or dad died. So they're better off to pay the 4.5% and not make the gift. And the benefit in all of that is if you don't make a gift, you don't have to worry about it being available for nursing home care. You don't have to worry about filing any gift tax returns. You don't have to worry about the capital gains when you sell it. So I always like to talk about the difference between the basis and the income taxes. What is Medicaid? And we're going to talk about this because when we talk about gifts, we need to know how this affects for Medicaid eligibility. So Medicaid is the state and federal program that pays for healthcare services, and it's administered through the Pennsylvania Department of Human Services. And most people needing long-term care eventually qualify for Medicaid, depending on the length of time they stay in the facility. So 2/3 of nursing home residents are actually receiving Medicaid benefits. Now, this is important because what does Medicaid pay for? It pays for nursing home care and the aging waiver program or the community health choices program. That's a program where you stay in your home and Medicaid pays for care to come into the home. It does not pay for personal care homes, assisted living, or most in-home care. Now, all of this is important in the context of gifting because there is a 5-year look-back period. So if a gift is made in any 1 month over $500, then it's going to create a penalty period. And what that means is it's going to create a period in which Medicaid is not going to be available to pay for your care because of gifts that you made. So what happens is if somebody would go into a nursing home today, what we would do is we'd go back 5 years, count up all the transfers that they've made to individuals over any transfer of over $500 in any 1 month. We add all of them up and we figure out what the transfer penalty is, the period in which Medicaid is not going to be available to pay for care. And the ineligibility period is for every $12,160 that you transferred is 1 month that Medicaid is not available to pay for care. So sometimes families, mom or dad, would be making a gift, not realizing that if they need care within 5 years, their child is either going to have to gift back what was given or they are going to be financially liable for mom or dad's long-term care up to the amount of the gift. So we just need to make sure that clients, that families are understanding what this means from gifting. So we understand our clients want to be generous. They don't want to be a Scrooge. They want to be gifting to their family members, but we just want to make sure we're doing it in a way that makes sense and isn't jeopardizing any eligibility for Medicaid. Now, can I just add my children's names to my assets in order to protect it against nursing home costs? And this is, we get about the dollar, transferring it to $1, or we get, well, I won't transfer it for $1, I'll just add their name to the deed and my name will still be on it, so it'll be fine. Well, again, from a gifting perspective, it is still considered a gift. So how that works is that, again, if you would need care within 5 years, that's still going to be a gift. It's still going to jeopardize your Medicaid eligibility. It also is going to make your asset available to your children's creditors. So we think of the 4 Ds. So divorce, debt, disability, or death. meaning that if my parents added my name to their deed and I got divorced, then their house is subject to my divorce. If I would get sued or would have any type of debt, their asset is subject to my debt. If I would ever need long-term care, their asset's subject to my long-term care costs. Or if I would die, then my share of their house might go through my will, which means that it might end up to my spouse or to any other beneficiaries I had under my will. So I always caution families to think about whether or not it makes sense to transfer the real estate for a dollar, or does it make sense to add the kids to the deed? And 90% of the time it does not make sense, and we would consider using a trust in that situation.